and welcome to Dude, What's the Bid? Episode 4. Fourth week in a row that Casey Larkin and myself have shown up to the same meeting and been relatively on time too, which is good. But this is a show where we're going to talk about the trucking market. We're going to talk about trucking stocks today as well. We have two special guests in that house. The first is Ed Burns from Burns Logistics, and the second is Seth Holm, my old work compatriot from Freight Waves at Westbrow. Is it Capital Management or is it Westbrow?
Yeah, it's just Westbrow Capital. That's good.
Westbrow Capital. And he's a hedge funder. He was a hedge funder, and he's back in hedge funds. So we're going to talk a little bit about stocks and equities and earnings reports and kind of what the public companies are coming out and saying, the condition of the trucking market. So welcome, everybody, to the show.
Thank you. Great to be here.
Yeah.
Super great.
Yeah. So let's start with you, Ed, and just a little bit of background. We do Burns Logistics, how that's a different business model than the most, I don't want to call it brokerages. And I don't know if that's a term that you use or how do you define it?
Kevin, thank you, because you were about to take me down a rabbit hole there. I was going to get really defensive. Yeah. We do not call ourselves a brokerage. We consider ourselves an asset sales agency. So the trucking companies are our clients. We work for them and help get them freight.
And that is, and those are independent carriers, right? It's
small to mid-sized fleets.
Yeah.
I'm a country bumpkin. I don't know about these big publicly traded carriers. I know about the small guys.
Good. And Seth, a little bit about yourself.
Yeah. So I run a long-short global transportation fund. I was at Freight Waves for a little under 2 years, running the research division, putting out a lot of notes on the trucking industry and companies and industry themes there, and then launched Westbrow Capital here about 2.5, 3 years ago, and now we're growing. And to my knowledge, we're the only pure play transportation hedge fund out there, and so we invest globally in anything that moves freight or passengers. So I spend my days following trucking companies, railroads, ocean shipping, airlines, autos, all that sort of stuff.
Awesome. And Casey's over here with his Goodwill hunting, as Seth calls it, whiteboard back behind him, doing his equations. How are you doing this morning, Casey?
I'm doing well, Kevin. Thanks for asking. It's a happy Thursday around these parts. Birthday tomorrow. It's my girlfriend Danielle's birthday today. Happy birthday, Danielle, May 23rd. But excited to have both these guys on here. A couple of different perspectives on the transportation, the freight markets. Excited to be here.
Casey, I heard you and Kevin have some perspectives too.
We may.
Yeah. So take a vote. Who's bullish? Who's bearish for the next? Because you have to put that in a time frame. You can't just say bullish or bearish because the market's going to be both over the long term, right? So let's say for the remainder of 2024, which I guess is about 6 months, right? So we're about halfway through 2024, which is amazing and depressing to think about all at the same time. But so let's go around the horn here. Ed, why don't you start us off?
I'm a bullish guy.
Yeah, just always. Are you an eternal optimist?
I wouldn't say an eternal optimist. I can really turn into Eeyore sometimes, but for the most part, and certainly for our industry, I don't think fleets, especially small mid-sized fleets, can make it at a lot of these rates for another 6 to 9 months. It's just not. How long can you run at a loss for? You just can't.
True. And when you say small to mid-sized fleets, how many trucks does that kind of cover in your mind? Because
in my head, it's 50 to 500 trucks. That's it.
Perfect.
Yeah.
Okay, perfect. Yeah. So they're struggling a little bit as well with both contract pricing and certainly fleets of that size, especially 50 to a couple hundred, are more exposed to the spot market than most people, I think, realize a little bit, because they think
They can be
almost 100% contract, which it's nowhere near 100% contract. I mean, it's probably high contract, but there's still about 20%.
Yeah, typically there's 60 to 80. Some get closer to 90.
Yeah,
percent contract. Yeah, but there's always going to be some spot exposure.
There is. Yeah. You can't escape it, which is good and bad. I mean, this market's not really all that great, but yeah. So you're bullish because of capacity declines.
I think I'm bullish because I think at some point carriers are going to get together and say we can't do this anymore. I'm hoping.
Mm-hmm.
I don't know. That's like fantasy world stuff, but I just, in my heart, I believe it.
That's good. You have to be optimistic.
Yeah.
You
also,
do.
Casey painted me into a corner. He said I had to be bullish because Seth was going to be bearish, and we were going to have a great fight today. So I'm just trying to play my part here, Kevin.
Good. That's good. That is really good. How about you, Seth? Bullish or bearish?
I'm bullish. I think we're approaching rock bottom kind of and I'm speaking of equity prices here. And for greater surface transportation, I know we're talking truckload here, but I think Ed made a good point. It's how long can you lose 50 cents a mile and still stay in business or want to stay in business? And so I think we've started to see the capacity exit. It's been the funny thing is, I think I picked the worst time ever to start a freight transportation fund, in beginning of 2022. It's been, I think a severe recession for the better part of the last 2 years, coming off the COVID fueled goods spending. And, it's been tough because, then you've had a high inflation for the last year and a half, 2 years. And that's been really tough because, at the same time that all the volumes were coming down for the truckload players, there was too much supply. So they lost their pricing power and their cost structure went up at the same time too, because everybody needed a raise. And so, expenses have been going up and revenue's been going down. And, the good thing, I think conditions right now are pretty ugly. I think we talked offline yesterday. There's been a couple transportation conferences the last 2 weeks. I think Bank of America and Merrill Lynch had one last week, and Wolf has been hosting one that I've been listening to all week, basically. And the commentary is pretty dire. But I mean, I do think we're starting to see some green shoots. I mean, I follow the FreightWaves data still. It looks like it may be because of road check week. It may be some minor seasonal bump, but the volumes and the spot rates and the OTRI, have been moving up, and frankly, it just can't get any worse. I mean, I think what I would be more worried about is like a longer trough rather than a much deeper trough, I guess is the way I would say it. Because how much deeper can you go, before you start parking the trucks, to Ed's point, selling them, just closing up shop. Bullish. And, I think also, what made this freight recession so severe was just, you were probably coming off the most juiced freight volumes. You can pick your number, maybe a multi-decade pull forward during COVID. And so I think that's made it extra tough this time around.
Absolutely. And, I remember hearing all these stories about the new entrants, right, into the trucking market. You catch a TikTok video and, you see you can make a couple $100,000 a year being an owner operator. You go out and you buy a truck at, inflated costs when everybody was going out to buy them. And Ed, I mean, in your experience talking with the smaller fleets of the world, have we kind of ironed out maybe some of those folks that hopped in without the experience needed to, be a profitable trucking operation? Or do you think we're getting back to, the true core operators making up the most of the capacity?
Yeah. I mean, it's nice because it's a really easy business with huge margins. So, low cost to serve.
No regulations.
Yeah, it's not right. We've been deregulated, so obviously there's nothing to worry about there. I go to a lot of conferences. I talk to a lot of fleets. I think the reason part to go back to why I'm bullish is because there are really good fleets out there who have operated for a long time. Multi-generation family businesses that, they could be in flyover country, but they are really good operators. They're all throughout the country, but most people don't know who they are. They have 100 or so trucks, call it, and they operate really well. And maybe they're in the second or the third generation, and that generation has grown the fleet, maybe 100% over 20 years, right? These are smart people who understand business and have been in trucking for a long time. And a lot of the ones that I talk to are very much strategic in their contract partnerships, right? So that's a big piece of it. But I also talk to some fleets who were 100% spot market. That's all. They didn't have contract customers. A lot of them moved to the United States, started as a driver, bought a truck, and in the last few years, before this freight recession, they were able to get access to money really easily, grow their fleet very quickly, bring friends and family over from maybe Eastern Europe or India or somewhere like that. And there's nothing. This isn't a bad thing, but there's a big segment of the trucking population that came into this freight recession completely relying on the spot market, right? Because it was really good and they were printing money on it for a pretty long time, right? There's a good 12 to 18 months there where you can make a lot of money. You could get $6-7 a mile for hauling, berries long haul across the country, and you do that a couple times a week, you're making money for sure, right? So there's multiple dynamics. There are multiple types of fleets out there, I think, with different strategies, but a lot of people are trying to jump into that contract space, and it's like too late. You can't just do that. It takes a long time.
And I think a lot of those fleets that you're talking about with the contract relationships and the multi-generational, those are multi-generational relationships with the contract partners. And I think that's what you see, that 100 truck fleet that's grown, from 50 to 100 over 20 years. It's slow growth, but it's steady growth. And what you find is that you have the same core customer base you did 20 years ago. And that puts you into a nice niche or a nice business that's consistent, that's predictable, that you have the processes in place and the, I guess, network dynamics in place to really run that. But that takes a long time to set up.
Yeah.
Yeah. It does. It takes a long time to set up, and that's where that's where it gets rough, and then the growth in trucking companies, right? It's Seth and I used to talk about all the time. It's like the scalability of trucking. It's very difficult. And that's the reason why.
Yeah.
A lot of those multi-generational families, instead of going out and buying more and more and more in trucks, they're often really big into real estate. It's usually you have the trucking company over here and the real estate company over here, because you're going to take your profits out of trucking and not necessarily reinvest dollar for dollar back into your trucking business. You're going to buy real estate because that's a little bit more stable, a little bit safer. Remember those conversations?
And even within real estate, they'll get a warehouse, they'll get some warehouse space. They start getting really sticky in with those customers because now they're taking over more of the supply chain. So even because shipper sentiments are definitely shifting slowly here, and maybe not so slowly, where the generation that really enjoyed and appreciated being called on and taking a dinner, and I don't think this is a bad thing, right? They like spending time and building their relationship. A lot of those people are retiring out now, and some of the new people coming in don't think that way. They're looking to prove a point. They want to save a buck, and so the carriers have to be sticky. They could have that 20-year-old relationship, but when somebody leaves, then what?
Then you're in the transportation churn.
Yeah.
The great transportation churn in the sky. It comes for all of us, right? At one point or another. Seth, what are you seeing in the earnings season?
I think that was a good point. I mean, what you guys were talking about, what trucking companies do, I think in any capital intensive cyclical industry like trucking, counter cyclical capital allocation makes sense. And it's kind of what I do with the public equities. You really want to deploy capital when things are terrible right now, at least I do, because there will be better times ahead. And you want to start taking capital out of the business when times are really good, because as Kevin just said, the piper will come, whether it's a month or a year. Earnings season has been rough. I mean, I would put it this way: even the darlings of the surface transportation, kind of the LTL in particular, they got whacked on earnings. And I think with those they pulled in a lot of, it's been the only place to hide out in transportation. The average transportation stock is doing, I think it's down depending on how you measure it, but the Dow Jones Transportation Index is down 2 or 3% year to date. The S&P's up 12 with NVIDIA and everything. So I think this year has been a surprise. I remember last year, everybody was saying terrible first half, great back half, the old back half recovery. And we got that again this year. And I think that has not played out thus far. And so it's just been, it's been that sticky capacity that people have not been able to, including myself, accurately judge how fast it would go away. And so earnings season was rough. I mean, I would say just about every company missed and or guided down their forecast. There was a few bright spots. One company I'm long, Wabtec, that makes the locomotives. That's been a good one, but few and far between. I think the question at this point is, Kevin and I talked about this all the time, so spot rates, right? I don't think spot rates can go any lower. They're already at irrational levels, pretty much across the board. I think the question is, just using round numbers, because whether it's DAT or FreightWaves or Truck Stop or whoever, but contract rates are around $2 a mile thereabouts, and spots around $1.50. I think the question from here for the public trucking equities in particular is, does contract come down to meet spot or vice versa, right? Because I do think the spot will bottom. And then there were areas of surprise. Actually, a couple of the freight brokers did okay because the spot, they haven't experienced that margin squeeze that we talk about, Kevin, with their business model. Spot stayed so weak and took a double dip that it actually helped them a little bit in Q1. So I think the bright spots in surface transportation, LTL has been doing. They've got more concentration in the market with the top three. XPO has been a great turnaround story. They've got more pricing power. They've benefited from Yellow going out of business. They're starting to anniversary those comparisons, so I think it'll get tougher. The railroads are starting to become, to me, more attractive. Rail volumes were negative for the better part of a couple of years. We've had like 15 straight weeks of positive Class 1 volumes. I mean, the other thing, the truckload market is really bad when there's too much excess capacity. I've heard this was very interesting to me. LTL and intermodal have been losing market share to truckload just due to the rock bottom pricing. But shippers have been substituting away just because, why pay more if you don't have to, and there's someone willing to haul it at a loss. So, I think looking forward to 25 will look really, really good eventually. And, the other thing that makes me, in addition to the spot rates kind of being into irrational loss-making levels, we still haven't experienced that restock. I think that's the other thing that would kind of give you a twofer, if you will, if you're a trucking investor. If things bottom out and spot starts going up and contract follows and the market gets tighter and you get the restocking at all the large sort of retailers, because That's also a little bit worrisome too, where it's a good question. Is the U.S. consumer, or is the lag effect of higher interest rates finally starting to hit the U.S. consumer? That was another takeaway. And I used to be a consumer analyst. I only follow it, kind of tangentially, but, Target had a bad earnings report yesterday. They're huge. They're starting to cut prices on groceries. That made the Wall Street Journal because people just can't take it anymore. And so as long as we don't have that, that lagging recession, I think things look really good in truckload from an equity perspective moving forward, just because it can't get any worse. It can get longer, just can't get much worse.
It can definitely get. I like when you said 2025 will eventually be better. Well,
good. So
I want to ask Ed,
if I could call the trucking market, I'd be I'd be managing a lot more money than I manage now. It's tough. It's a tough call.
Sure. So Ed, Seth was talking about contract versus spot.
Mm-hmm.
How have contract negotiations been over the last, maybe 12 months or so, or during this cycle? And what are your expectations?
I remember
going forward. Go ahead, Casey.
On that, if it's all right, Ed. I remember when things were hot. Seth was starting his new hedge fund, Westbrow. There were a lot of SPACs in the space, and people were talking about shortening, contracts or RFPs down to like 3 months. Since things have softened, has that changed the contract environment at all?
I can really only speak anecdotally. I don't know, like across the industry, just from what I've seen, is that people who changed their schedule have stuck with it so far.
So the shorter type of contract.
Pardon?
So are they like shorter contracts? Are they like 3 months? I remember 2, 3, 4 years ago, it was traditionally 12 months or sometimes even longer. And then when things started to fluctuate a good bit, it seemed like shippers were shortening the lengths of those contracts to 3-6 month terms, just so that they weren't.
Yeah, that was all the rage.
Those.
Yeah. 90% of the shippers we work with are annual.
Yeah.
Yep.
And that with with a few exceptions. And some, look, our favorite shippers are the ones who don't go to bid, right? Because they'll contract a carrier and stick with them forever. And it creates a very stable relationship financially for both parties, because here's my rate. Okay, this works. COVID happens. Hey, I need a 5% increase on these lanes and 7% on these lanes and 3% on these. And then the shipper says, okay, that works. And then this happens, and they don't come and say, oh, you got to lower your pricing. They just leave them where they are. So in a tight market, the shippers who do that don't have their budgets blown up. And in a soft market like this, the carrier continues to operate profitably on those lanes with that customer. I really wish everybody did that or got closer to it, because the stability is healthy for everybody, right? And the instability hurts people every time. It's like, I don't know why this industry can't learn the lesson, because it just keeps happening. And every time it's like a big surprise, it seems like. But there are people out there who just do this strategically and really don't have a lot of exposure for on both sides to what's going on.
Yeah, but I think that's a good point, Casey. When the market gets hot, and I've seen this across other modes of transportation as well, when the market gets hot, the shippers want to do mini bids so they don't lock them, even though they're paper rates theoretically, and they don't necessarily have to honor them. See people move to mini bids. In fact, I've seen the same thing going on, within the ocean shipping container market. Rates have skyrocketed in the spot market, across pretty much every lane, because the Red Sea has been effectively closed all year unless you're running a Chinese container ship. And so, spot rates have doubled or tripled, year to date, somewhere in that. And a lot of the ocean shipping shippers were looking to rather than play the spot market, trying to lock in mini bids and shorten the duration of those contracts, to your point. And that it seems like, the container stocks have recently moved up because the shippers are starting to finally cry uncle and realize, the Red Sea is going to be closed for a long time. And I think people thought it was going to be a month or, a couple weeks, and it turned out it may be all year. Who knows? But I think that, on the contractual side, what I would speak from the public equity side is, if you look at the consensus expectations across the sell side, the analysts that cover the stocks, and then the buy side that I'm on, where people invest in them, I think people were looking for, kind of positive low single digit contractual rate increases, to begin in the second half of the year. And it sounds like that's been mostly dialed back to either flat or modestly negative for most people on the trucking side. And so, but eventually, how far can you, because even you're bumping up against your expenses, even at current contract rates, because, if current contract rates are flat for the last 2 years, operating costs are up double digits at least. So,
you gotta keep up with the rate of inflation, at least. And it's not to mention that like insurance costs are skyrocketing, for carriers. And at the same time, shippers are starting to require greater insurance coverage from the carrier. So now they got to go out and buy more insurance, which is more expensive. Oh, and by the way, you have to do it at a lower rate. Okay.
Yeah.
And I also read. I'm back now. Sorry, I missed a couple
We
of
missed
minutes.
you.
So I'm just gonna. I know I'm just gonna butt into the conversation because you brought up a point where I just read. I think it was Jersey, like New Jersey just raised their insurance. What do you call it? Insurance limit. Requirements. Yeah. And I guess that's still in force and moving forward, right?
Yeah.
What did it go up to? It went up to, I can't think of the exact number, but it was significant, right? So if you have, and I don't know how that really works as well, right? So if you have operations or a terminal, or if your truck is licensed in Jersey, then it applies to you, but maybe not if you're out of state, moving loads in and out through the state.
Right.
Yeah. They increased the minimum liability to $1.5 million.
Is that for trucks just licensed in Jersey, with state registration? You have like California. Yeah. If your truck even enters California, then you have to be CARB compliant, et cetera, et cetera. So I was curious about that kind of brought.
My understanding was it was anybody who was operating in Jersey. So if you're running trucks in Jersey, you got to have it.
Okay. So does that mean if your truck enters New Jersey, you got to have 1.5 million as you travel through Jersey? Or
that's a
and I know
question.
You probably don't know the answer off the top of your head.
I don't know
as well, right?
Yeah.
But to me, you're in Pennsylvania, so that's just like across the river.
I can practically see it across the river.
I know, right? You
look
can see it from your back door.
And I look over and I look at the poor people living in the Communist Republic of New Jersey, and I think, why would you do that?
Bears coming down from the mountains fighting in Far Rockaway, New Jersey. It's maddening in the Garden State. But no, you got the insurance costs going up. It's hard to find a place to park. And you go back to kind of this conversation about the race to the bottom. Right. And Ed, there are some great operators out there who've got great relationships with their core customers, and they figure out a way to do things somewhat profitably, or at least closer to profitability than, maybe some of these folks that are on the spot market and exposing themselves, running at a loss. Seth, you're mentioning like 50 cents a mile. Is there a world where, why are these companies running for a loss? Is it because they don't know what the operating cost is for their truck and they're just trying to make some money to stay in business? I know that usually takes you getting to probably 100 trucks before you can hire a guy with an MBA to really start crunching the numbers and figuring out what your operating ratios are and where you're strong, where you can improve, things of that nature. So I don't know. I guess one of the things that I'm thinking about in terms of trying to iron out some of the cyclicality of the market is can we increase price transparency to let these truckers know, where they could make the most money, or what their truck's going for, so that they're not bidding at a loss.
It's a great question. I mean, it raises the question to me. I mean, I think the response that we often hear, I think there's been Craig at FreightWaves has said maybe some of the brokerage apps are helping keep some of the smaller fleets in business longer than they otherwise could because they can now find freight. It also raises the question of, do they know that they're losing money? I think that's a good question. There's a lot more visibility on the revenue side, at least, certainly relative to the last 5 years, but with 3.9%, what is it, 40 or 50 year unemployment, you would think more people would go do something else where they are making money. On the public carrier side, they still, for the most part, are making money, but ORs, some of the good operators are above 100 OR. You're looking at 90, let's call it an average of about 95 ORs. And 2 years ago, and the 2.5 years ago in the good times, those were low 80s. So and then of course the owner operators always do, at least when the data set that we always had at FreightWaves, the owner operators were always the smaller fleets, and the owner ops were always less profitable than the enterprise fleets. So that tells you that most people are probably losing money. And so I think the one stat that I saw concerned me regarding whether I'm bullish or bearish. So I think if you look at the FMCSA data, Kevin, you correct me if I'm wrong here, you've been posting on it, but the carrier count is up like 40% since pre-COVID in 2019, and we've only burned off a fraction of that. And so I think I read, I don't know if it was a research report or one of these conferences I've been listening to, but at the rate of exits and capacity exits we're seeing, it could take a very long time to work through this. Basically, is the
it did. If you look at the charts, Kyle Taylor, a friend over at FreightWaves, still he posted this quite a bit as well as a sonar chart with those carrier counts that you just talked about, and I saw another former colleague, Andrew Cox, over at Stifel. They did their April monthly truckload outlook. I got that this morning, and he has some numbers in there. It's kind of plateaued, right? Those exits have plateaued. And while they burned off really quickly in the early stages of this downturn, they've kind of plateaued. That brings up another question that I'm always asking myself and asking everybody else as well, is like the carrier counts are a good directional indicator, right? But there's only so much you can glean from that. And one of those problems is you saw this huge boom, in 2020, 2021, everybody getting their owner operators, or everyone becoming an owner operator. It became, actually, you're talking about it, Casey, TikTok videos and stuff. It became a get rich quick, which is crazy. Brokerage did too, right? But if you look at it, so I'm a driver. I leave one of the enterprise fleets, one of the large fleets, or any fleet, and I open up my own MC number. Great. I operate on that. I get into these conditions, and I'm like, crap, I can't make any money. So I am going to now get a job back as a driver. So I revoke my MC number. If I do that, I might just keep my MC number as well, right? Which throws another skew into the data. And I'm going to go back and work for that same fleet, let's say. Have we added or subtracted any capacity in those moves?
Yeah, it's zero. It's a net. It's a net zero, but it's I guess you still you haven't subtracted that one registration though that you theoretically in reality that you have. Maybe you do subtract it, maybe you didn't, but net is zero, right? And you look at the BCOs at Landstar, right? It gives you it's more of a sentiment indicator, right? If the market's good, you're going to start your own business. If it's not good, you are going to go back to driving and become a W-2, right?
does it really take a driver out and put a driver in? That's something that's really hard to tell.
Yeah, that's true, Kevin. But I think what a lot of people did too is like, they bought these dually trucks and got a 20-something foot long gooseneck, and they started doing hot shots because they didn't need your CDL. I mean, that does add capacity to the marketplace. Is it a truckload move? No, but some of that stuff could be moving, flatbed or truckload potentially.
It could, yes. Yeah. So that's right. That's how do you juggle? How do you get an accurate number, right? Even CDL drivers, right? I saw that print. Andrew had that print in there as well. I can go get my CDL. Am I actively employed where I need a CDL or not?
Mm-hmm.
So it gives you really good directionals. Same with used equipment prices, right? Used truck pricing. I mean, when a 5-year used truck is $150,000. I can't remember exactly what it was, but it was amazingly high in 2021, right? Those are still declining in price, right? So you don't see any rush of new capacity or new businesses opening corresponds with LMC. So it's really tough to get a sense of capacity entering or leaving the market for supply demand fundamentals, right? You can see sentiment and all that, but it's hard to get exact numbers. And I think that's where we all kind of, it's very opaque still.
Yeah,
for sure.
Absolutely. And I mean, you're not even talking about modal shifts, like I mentioned, where strippers can switch modes. And the other thing, I mean, this cycle's been tough because you had sort of, I don't know, a once in 50 or 100-year pandemic that, I mean, we're talking a shift of, the U.S. economy is what, 26 trillion or about. And so, when you've got 2/3 of that goods and services, basically 50-50 go to 60-40, it's a multi-trillion-dollar shift. Mm-hmm. And, the other thing that's added confusion to my daily investing life is, you kind of, and I heard some of the CEOs talking about this yesterday, everybody had the age of the equipment was pretty high relative to history entering the freight boom and COVID. And so you had, a record high freight market with, really low, high average age. And so like, even in the midst of a multi-year freight recession here, truck orders have still been holding up and creating distortion and confusion, to your point as well, because there was a semiconductor shortage and they're trying to get ahead of, the changes in emissions and trying to get their average fleet ages down. And so it's really hard to get, I mean, you kind of got to take a bunch of different data points. You can't rely on one, at least someone like me as an investor. You got to take as many as possible and kind of synthesize them and analyze them together, because this is not your typical cycle in many ways, to your point.
Hopefully a once in a lifetime event.
100%. And did it totally change the way that we consume goods and then the way that the freight market works? I mean, Seth, you mentioned, and yesterday I was talking with a guy who runs a brokerage. He came from Convoy, and now he's at a brokerage that's a little bit more niched up. They like to move a lot of Sprinter vans. And something I learned yesterday, right, is Sprinter van drivers, can do relatively long hauls, but they're not, they don't need a CDL. So they could run 1,500 miles in a day, right? If they've got the right attitude and enough energy. So as things shift to more of a final mile,
strong solo,
or a last mile type of economy, right? We want our stuff next day, same day. Does that shift the modes? Seth, you mentioned the container rates going up. I remember last time container rates went up. Our old friend Henry Edwards, Buddy the Elf, called the market's turning, and everybody called him crazy.
Yeah.
So if we think about container prices as a leading indicator for the freight market, rail, you said, is strong as well. If the supply chain becomes more efficient, we can use boats and rails and use the trucks to get stuff to the door, to the retail center, the brick and mortar. Does it change the way the market looks? Is the future of trucking small? I remember that was a conversation that we started seeing. So I don't know. That's what makes me think about.
And to your point, adding on to that, I mean, imports have been pretty strong in most of the major West Coast and East Coast ports. can't remember the exact data, but up mid-teens year over year. And a lot of people got caught off guard when it comes to the intermodal players, the JB Hunts and the Hub groups of the world, because you would think those double-digit increases in container flows would flow into their business. Now they're domestic containers, and one thing that international intermodal has been really strong. If you look at the data, and it hasn't fed into the domestic intermodal market at least yet, although my buddies from FreightWaves were texting me this morning the chart of the domestic loaded containers. Looks like they are starting to show some green shoots and pick up here, but you would think all those imports have to go somewhere. They either go into a warehouse, get transloaded, or they go somewhere. So you would think how long can that strength continue without having a strong either trucking or intermodal volumes? And so that one's been puzzling as well for me. So
would there be a good lane to look at? I mean, I'm thinking LA would be a good.
Yeah, all those LA to Dallas, 7 LA to Chicago. There's really similar to ocean shipping. There's what, 7 or 8. It's 95% plus contractual in intermodal small spot market, and 7 or 8 lanes account for what, like 90% plus of the volume. So there's definitely a good read on it, but there's a lot of confusing signals out there, is my point, that are difficult to analyze. And the other thing that I think we haven't talked about in the truckload market is we have high nominal GDP, right? But unfortunately, trucking is really, the revenue side of trucking is tied to units, right? Or sold. So just the fact that the dollar value of the cargo, if you're moving less units but the dollar value is up, that doesn't really help them. You need the units to rise for rates to recover.
And you're talking about inflation now.
Yeah, but I mean, my point is, look, if consumers spending is up 5% year on year or thereabouts, and it seems to be weakening, maybe on a real basis it's approaching flat across most areas, and that's not going to help the trucking companies that have, they're levered to volumes and they have high fixed cost base, and so they're kind of in the worst of both worlds. They're in kind of a disinflationary or a stagflationary environment that is really hurting these guys. So
how do you guys see the November election results impacting this?
Seth? You want me to answer?
No.
Well, it certainly depends on who wins. I think Trump. So let's think. I'm thinking out loud. It's a good question. So here's how I would say it. Okay, I think Trump would be, certainly protectionist. He would continue his old ways, and that would really add to the nearshoring boom, which theoretically should add a lot of domestic and kind of North American freight for everyone. It would probably hurt the container side eventually, because if relations with China got adversarial again, I think it would hurt container, particularly on the container shipping side. There's a massive order book. It's similar to trucking, 30% of the fleet on the water. I think it would be bullish for trucking. And the other thing that I remember, what was it, back in 2016, he got elected. He likes to do those, accelerated CapEx type things that could drive fleet expansion and renewals. And they can be artificially sweeteners, I guess, that can really juice things temporarily. But I would think Trump would be net bullish. Biden, he's tough on China as well. I think that, my opinion is, people are tired of inflation. So inflation's going to decide this election. And I think if it's Trump, he's bullish and maybe neutral is my answer if it's Biden.
Okay. Kevin and Casey, what do you guys think?
Well, I'm thinking bridges are collapsing. I'm thinking infrastructure probably.
I hate to laugh at that, but
could use a juice. I don't know, right? Is that something that would be top priority list for the Biden administration, getting an infrastructure bill in place?
Well, aren't they building back better?
I think, maybe that's more metaphorical than from an infrastructure type of perspective. It's been a while since Eisenhower developed the interstate system, and I don't know. I feel like, yeah, it could be a boom for the trucking market, and I don't know. I mean, I continue to pull up lanes here in the background while you guys are waxing, and it seems like, I don't know, prices are going up on the average line haul, and as things, I don't know, shift to more of that nearshore economy, Seth, is that good or bad? And how does that kind of tie in? I mean, obviously the USMCA was a Trump policy. They got rid of NAFTA. I don't know. I think a lot of truckers are in support of the guy sitting more on the right side of the aisle. Seems like it would be a good thing, but.
Yeah, I mean, I think I don't really have too strong of an opinion. I just think Trump is certainly more pro reshoring. I think they both are, but he would be more. The other thing that we haven't talked about, if you can kill, I think if we can kill the inflation and have the Fed cut interest rates, the trucking market will bottom. And because, housing market is, I'm in a whatever golden handcuffs, as a lot of people are. My mortgage, if I just moved into the same house, would triple, like literally monthly. And so I think if you could get just inflation to hit the Fed's core PCE target, or whether such that they could cut a little bit, that would rejuvenate the housing market, which is, big for, it's most consumers' number one asset. And there's a lot of derivative freight flows that would start to bottom out and accelerate off of that. So I think almost more importantly than, who wins the election, it's if we can tame inflation, that will really help trucking, because it'll allow the Fed to cut and consumer spending to accelerate.
It's Rob Bussey. We are seeing an uptick in pricing for loads for sure, which was possibly jump started a bit by Blitz Week and now the holiday. So yeah, you had Blitz Week and then the holiday. Really quickly, if Trump is elected, then we might see another pull forward like we did in 2019, which this rush of imports. So we would really see a lot of containers, which give us a short-term bump. I think, again, nearshoring, Mexico is a structural play, and interested to see, stocks and trucking companies with some kind of cross-border, especially southern cross-border exposure, if those are attractive investments or not. Because I think it's I think it's a big story no matter who's elected on that front. I think independently from politics and regulations, that I think a lot of companies are bringing manufacturing back to this side of the world, to the Western world. Again, I think that's a trend that we'll see for a long time.
Yeah. I mean, I think it's hard to argue that, it's politics holding back the trucking market. You know what I mean? It might be marginal, but I mean, we're running like a $6 trillion deficit, and spending on all sorts of infrastructure and other things, whether that's green infrastructure and not Casey's bridges, who knows? But things are really weak. I forget his name, but he just posted. I listened to Derek Leathers, the CEO of Werner, yesterday at the conference, and he made an interesting point. He said, "Look, whether this the bump over the last week in spot rates, whether that was just due to road check week or not," he said they internally, and I thought this was fascinating. He said, that the market is starting to tighten a little bit, no matter what, if rates jump during road check week, because he said if it's really, really loose, they won't jump much at all. And so I thought that was a good point, that maybe some very early indications that some of this positive data that we're seeing could have some effect to it.
Well, not to be a pessimist about that, but I think Casey sent me a Truck Stops article on rates during Blitz Week, and they're one of the softest on record.
Really?
From their data set. But I mean, and then like the other side, I saw a post from Kevin Nolan last week. I think it got picked up in Freight Caviar. He said the floors were buzzing. It's the first time he had heard the floor sound like that in years. It does make you wonder as well. And like, the other thing that I think is interesting to think about is where are you getting your rates from? Are you getting them from brokers when the brokers pay the invoice, or is there a way to identify price action moving if you're looking at rates that carriers are being paid by banks, right? A lot of times. So if we're pricing freight on volumes from a month ago, it would take a little while for the price action to catch up, depending on what your data source is.
It will, yes. It's
possible, right? I guess to that point, truck stop, right? I don't know. It's possible that they didn't capture the bump that Grant and Derek Leathers and Kevin Nolan are seeing on the floors anecdotally.
What did Ed see? On certainly on capacity, you might not see much in the way of spot rates because that's not an arena that you're playing in. But capacity wise, I mean, what did you hear last week?
Yeah, I mean, I didn't hear anything. I mean, the fleets we're working with are going to move the freight, right? They're not going to give it back. So, so I'm a little ignorant on this.
Okay. Yeah, I wasn't sure if just on the capacity side that there's a little bit more strain throughout the market or throughout what you're seeing. But yeah, it's good. The contract life is good. The contract life is good. It's nice and steady, and you don't have to worry day to day. We on the brokerage floor. I was always contracts are the best, nice, consistent, predictable lanes.
Yeah, you
live the transactional spot lifestyle, and that's when you get calls at 2 a.m. and fires every day. It's not a great life.
No,
not at all.
No, but you know what? Some people really thrive on it. Some people are wired for it.
Yeah,
for sure.
It's more like a trading floor at that point.
Yeah.
You're in a trading floor. There's always excitement, always adrenaline, always getting yourself out of pickles. So I mean, it's fun, but it's a little tiring too.
Yeah, absolutely. But a little bump of cocaine, you keep rolling.
Sounds like you should be an ocean shipping investor, Kevin. There are many parts of the ocean shipping market are just 100% spot all the time.
Yeah.
And so if you like volatility and not knowing where you're going next, the spot market's for you,
Yeah.
I don't need 5 phone calls coming in at once all day long. Again, I really don't need that. I do have a question for you, Seth, right? When you look at the market, where there's technology, outside of transportation, what's the industry that you think is a melting ice cube?
Oh, a melting ice cube. So you want me to talk about shorts? Well, let me tell you what I do. I'm a friendly short seller. I'm a cyclical. I basically go long, short cyclicals. And so I'm looking to go, it's not personal. I'm looking to go long things. And I do, I am a value investor and I do deep fundamental research and know these companies. But, I may own something for a month or a couple years, just depending on how well things stay and play out. And so I'm just always looking for the next weakening market to go short. It's no hard feelings. Just that market's going to be under pressure for a month or a quarter and so forth. And so I think trucking, for example, we talked about I'm bullish. I think, I used to refer to this as trying to get that last piece of meat off the chicken wing. You might lose a tooth. You're in that phase with trucking. You're shorting in the hole is what some of us professionals call. And, you short in the hole, you might make some money. You're going to go short forward air. It's lost 95% of its value. And, that's a tough trade. So really what I'm looking for is, I would say on the long side, I've been able to avoid a lot of the carnage here. I've played in aerospace, some of the areas that are more protected and more recession resistant, and ocean shipping. There's been ocean shipping. The supply is easy to measure. It's the opposite of trucking. There's only a couple thousand ships, and how many there are and how many are coming out of the yards. I think shorting has been really hard again, man, because you're fighting the Fed shorting anything right now. This brings up, the U.S. stock market by any historical measure is in the 99th percentile on every single valuation metric. And, people will tell you, well, this time is different because of NVIDIA and so forth and so on. And it's tough to short anything. I will tell you, I've been on the transportation side. I think it has worked, and I won't mention any specific names, but, I've been short things that are interest rate sensitive, kind of tied to consumer durable spending, which has been pretty terrible across the board. Like you look at Home Depot last week, they sell more appliances and dishwashers and laundry machines, and that stuff is really hurting anything tied to the housing market. And so and I had been short a lot of the auto space. Just Kevin, I don't know if you knew this, but to get even with like an 800 plus credit score to get a new car loan right now, well, it's for an ultra prime credit score. It's 10% for a new car loan, and it's approaching 15 for a used car. And so, stuff like that, it's going to get tougher. Particularly, I will tell you what I will do on the freight side is I will try to, because I think we're at the very end of the cycle and maybe beginning of the cycle, I want to own the things on the long side with positive operating leverage. I know we always had a chart on our research team where, I would just say, very broadly speaking, you want to own truckload early cycle because it's got so much fixed cost and financial leverage, all of that embedded in there. Anything asset heavy, I would less prefer the freight brokers because I think they will eventually get squeezed. And I also think that the freight brokerage market, not Ed's business, but some of the big publicly traded, it's mature and has seen most of its, better days. And so you got to pick your spots. Not all of them. I'm just, I think as spot rates move up, that would be a less attractive area.
Yeah.
If you're talking shorting surface transportation, it's hard because these stocks are all down. Pick your number, 50% at least off of their peak from 2 years ago. So I think slim pickings in surface transportation. I
wouldn't short anything in service right now. I mean, you're at the bottom of the market. It's time to buy, right? Are there any technology stocks out there or consumer stocks that are just overvalued?
Yeah, I think all that. I would be shorting all of. I would be shorting a lot of that or all of that, just speaking generally. However, I have to run a transportation only fund. And so the other thing that I do, Kevin, is, I will do like relative value trades or pair trades. Some people might call them where, you might say, well, if we're in a new upcycle, you would want to have more net long exposure to people that have spot exposure or, over the road contractual exposure relative to dedicated. I think that those stocks will go up more. So you can implement it lots of ways there where you don't think that a trucking stock will go down. You just think it will go up less than 1 year long. So, I think technology, and I'm not an expert here, but I mean, the AI stuff is pretty heady. I think no matter, do I really think it's going to permanently increase GDP by 3% annually? Like some of these things that I've read? No, absolutely. I think that's a long shot. So I think, I can't do it, but I would be looking at some of those areas, if I could. They're a lot more fertile than trying to, what's the saying? It's hard to get blood out of a stone. And I think you're at that stage shorting transportation. So.
Yeah, I would not short transportation right now. Short them in 2021, maybe late 2021. That would have been good. Early 2022, but certainly not now. Ed,
Kevin,
what's the major thing that you're looking at in the trucking world right now? Like long-term trends, structural trend, where something that you keep coming back to as a central theme to what you're thinking.
This is what keeps going through my head right now, Kevin. I think our industry has a very serious trust problem. There's a lot of technologies out there trying to address this, whether it's the fraud or the theft or the double brokering or the way that contract negotiations or spot market negotiations happen. There's a very serious trust problem. And Seth, I mean, I hope you can comment on this a little bit, but like a lot of the way that the market goes. It's like an emotional thing. It's like, do you trust it to do well? And if you do, it's going to do well. And if you don't, it won't. When confidence is high, there's better performance, right?
Mm-hmm.
You talking the trucking market or the stock market or both?
Well,
Trucking.
mostly the stock market. On the market.
Stock market?
Yeah, that's called so the Fed, for example, did things really get better? So much so that the PE multiple for the S&P 500 is up 30. There hadn't been a lot of earnings growth, I'll put it that way, but the market's up 30, 40, 50% off the lows 2 years ago, and that's all multiple expansion because the Fed has said we're essentially done hiking. And so to Ed's point, the media calls those financial conditions, which are basically stock prices and, the wealth of your house. So one thing I think that this Fed they've really been, I think it's hurt the trucking market. They seem very intent on keeping house prices and stock prices high to create that wealth effect, to Ed's point. But that really is harmful to the trucking market because it creates sticky inflation and, and really financial gains as opposed to real income gains and that sort of thing. And then, certainly you got more money in your stock account and in your bank account. The economy can get better just because, stocks start going up. It's a well-known phenomenon. And maybe we're upon that right now. The market seems to think so.
Yeah. I mean, I don't know what they thought was going to happen when they added $6 trillion to the money supply in short order. They're like, don't worry about it. Nothing,
Yeah, it's tough. And, it seems like though that it raises so many, one thing that I struggle with is it seems like they won't allow recessions anymore. And that's fine. That's good. That's a net positive for most of society, but for financial markets, it makes my job really tough because it distorts all sorts of economic indicators. And, you have zombie companies that go up and then you have meme stocks. The meme stock thing started again a week or two ago. I don't know if y'all saw that, which speaking to Ed's point, that Fed funds rates at 5, you're not really in tight financial conditions when GameStop's going up 200% in 24 hours. So that means there's a lot of money out there trying to find a home in one way or another. So, I mean, this is a really unusual cycle.
Well, and there's no free lunch. There's no free lunch. So if you don't allow recessions, you're going to just build it all up to have a really horrible implosion like the Great Depression again. Because you can't paper over it forever.
Well, particularly
you bring in the bond vigilantes. If people stop buying treasuries, because our financial conditions are rapidly deteriorating, debt to GDP is surpassed World War II. But I don't want to sound like the bearish hedge fund guy. But that stuff will matter one day. Absolutely, it will matter. And yet, to Kevin's point, maybe you're prolonging we should have probably had a recession. Everybody thought we were going to a year or two ago, and it didn't play out that way because they took an elephant gun to fiscal spending and and prevented it basically. And so, but yeah, I mean, I think the other thing that's just painful, just as an American, why with the amount of debt that we've added and we didn't lock in long-term interest rates, back when they were nothing 2 years ago, that hurts. So there will be a price to pay. I have no idea when. It hasn't mattered for the last 40 years, as leverage has increased. And so, but yeah,
Yeah. So Kevin, Seth, you know what you're talking about. But the trust issue from the carrier perspective with the shippers, the adversarial nature of these dynamics with brokers, with shippers, with carriers, like this is a problem, and it creates the market volatility, right? So I don't think that's necessarily like a fix that tech is going to make. I think this industry's got there has to be a certain cultural change within the industry to create some trust between parties, or it's just going to keep being really ugly.
It is. It seems to repeat itself on every cycle, right? Whoever has the upper hand is going to maximize the benefit of that, which creates the volatility, right?
Yeah.
Right now, if I'm a shipper, I'm going to push down prices aggressively. 2021, I'm a carrier. I am going to get everything that I can get. And you have this adversarial, as you said, Ed, this adversarial relationship that keeps going back and forth. And a lot of us talk about, ending that. You're talking about it right now. I wish we could. It would lead to a more stable environment, more business friendly, I think, or partnership friendly way, and give everybody a little bit more predictability. But for whatever reason, free market lovers have to kind of love, because this is as pure a free market as I've found looking around, which is fun and frustrating all at the same time. But you're exactly right. I mean, it's just like we go through these cycles, and it doesn't do anybody any good except in the short term.
Yeah. Look, Kevin, I'm a free market guy. I'm no Keynesian, so I look at the federal debt that Seth alluded to, and I think the bigger it goes, the harder will fall, and it's going to be pretty ugly. But but even within the free market of trucking, I think people can learn to play ball a little bit better. So I think part of that's just cleaning up the procurement process, honestly.
Yeah, and that's a good point too. Procurement, which is the word where deals go to die, is procurement. Yeah. It seems a lot of times, right? Because procurement are judged, their job performance is judged on getting the cheapest possible prices with enough service to be adequate, I suppose, right? To where the business isn't falling apart, which is it kind of filters out differentiation. It filters out a lot of good business practices if you go through the procurement, your traditional procurement process, or any type of procurement process that is judged based on prices. Yeah. You're going to say something, Casey?
Yeah, I was just going to piggyback on that. I remember, Seth, you mentioned Target earlier. I remember a couple of years ago, I think it was their CEO came out on an earnings report when people were paying $7,000, $8,000, $9,000 for, a truck. I think they said they spent $1 billion on transportation and logistics that year.
Yeah.
So is that an environment where like that type of shipper who got clubbed over the head a couple of years ago, right? They're just going to like claw back and race to the bottom for as long as they can to try and make back some of that delta from a couple of years ago. Is that like the standard practice? Yeah, exactly. Right. You're going to get,
Well, if you think about it, shippers too, I'll step in here. Shippers have to think about those investors, right? Those angry hedge fund guys.
That's what I was going to say. Yeah.
Shipping goes into that gross
bottom line. When they can. The problem that one of the issues with, the level playing field and why, we had the pricing power index at FreightWaves, because, they're one side's always trying to leverage the other, is the shippers are really concentrated, right? Whereas the trucking market is fragmented, and those shippers are publicly traded companies that answer to their shareholders. And if you can get cost savings without sacrificing, on-time delivery or exceptions or whatever, your shareholders want you to do that. And so those, to me, the big, huge public shippers, Target, to Casey's point, they're either going to go, they're going to shift modes. They're going to increase their private fleet. They're going to lean hard on their carriers, put out more bids. They're going to do whatever they can to try to squeeze some extra cost savings when it's available. Especially when, to Kevin's point, you can look at like earnings call mentions, right? So like the latest one you look at, if you look at AI, it's like every single CEO in the country is mentioning AI 15, 20 times in the conference call. Well, a couple of years ago, it was supply chain inflation and bottlenecks and whatever. And so I think that, given that left a bad taste in a lot of people's mouths, to Casey's point, and I think, even Amazon and Home Depot were buying container ships at one point there. It got so bad that, but, that can move fast, as we know. To Kevin's point, it can all of a sudden, the one thing that's so fun about being in this industry and all of these industries is, spot rates all of a sudden jump 25, 50 cents quickly, or we get some sort of geopolitical event or anything, the playing field can shift quickly.
Yeah.
Absolutely.
And for the record, Kevin called you angry, Seth. I think you're probably like the nicest guy.
Well, I actually have a question for you, Kevin. If I can play host here for a second, a wise man once told me, trucking stocks trade on spot. So Kevin taught me a lot of what I know about transportation. He and I sat together, and he told me, I think it was my first day on the job, that trucking stocks trade on spot, and spot's been going up, but trucking stocks are going straight down. So what's going on, Kevin?
Spot's been going up.
Well, at least the sources that I look at, modestly,
yes. Trucking. That's a really good question. I will say over the long term, trucking that they haven't hit
he's
the
hedging,
bottom.
guys. He's hedging.
I think I think contract rates are coming down. I don't know.
Drop an anchor.
Someone wrote a paper on it that you can probably Google out there, and you get Seth Holmes' paper from, I don't know, when was that, like 5 years ago?
Yeah.
Trucking rate. Yeah.
I'm just kidding with you, but it's it's interesting that I texted you guys about this yesterday. It seems like, from my perspective, that the market seems to think that this is going to get worse and or stay really bad for a very long time, and it's confusing me to some degree, because you would think there's only so much that you can take here, but
yeah, I get this. People ask me this all the time. I'm sure, what can move the market right now, and I can't put my finger on any one event that will move the market anytime soon. Interest rates falling, maybe. But then again, I think in January and February, I would say that we didn't have anything to put our finger on, but we were talking. We did talk a lot about the pandemic. I guess it wasn't a pandemic then, but whatever was going on in China, in our little corner of the office at FreightWaves, right? JP was talking about it all the time, and everybody else was as well on that. But we didn't think it was going to turn out the way it was. But yeah, like in the first quarter of 2020, I mean, we were in the melees of 2019 and wasn't sure, kind of having the same conversation almost, right? And all of a sudden the world changes. Hopefully it doesn't happen again. But I think when it does shift, it'll be something that no one's really talking about.
I'm thinking it's a nationwide campaign called Say No to Cheap Freight.
It could be that as well. Say no to cheap freight.
Yeah.
It'd be nice, I mean, and it is interesting, right? I'm a free market guy too, right? But a lot of things that, say no to cheap freight, right? You go back to the unions, right? You go back to, regulation, and then you have deregulation, which brought in the free market, right? And brought in the volatility and brought in all these dynamics. And it's like, because I was about to say that everyone should band together. You said it actually, Ed, right? Everyone should band together and say no to cheap freight. And I think that's
not as a union though, Kevin. Not as a union.
Oh, not a union though. All right. I'm not talking about unions, but
on a personal
how do you do that without
costs? And figure it out from as the head of the table, I guess, right? Would be the would be the argument. If we all take a step in the right direction, decide to be prudent, solid individuals, figure out something that works. I think, right, it's a relationship business at the end of the day. We kind of talked about this last week with Reed Loostelot a little bit, and Ed obviously is testament to that as well.
Yep.
If you want to be long for this market, you better have some awesome relationships. I think technology can help iron out some of the problems, but what it really comes down to is developing those relationships, whether you're a broker and that's with the carrier, or whether you're a carrier and you're developing relationships with brokers. It works so many different ways in the industry.
It can help you. Technology can help you help your workflow. It can help you get better, but it can't replace that relationship building, right? And I think Ed pointed out earlier in the conversation, you have all these fleets, 100 trucks, 200 trucks that no one's ever heard of, right? Or that aren't household names. They've just done it the right way, right? You add in some technology to that, they do it the right way better. But yeah, that's what it's all about. And that's a large chunk of the trucking market, which is good. That's great. And it doesn't get talked about a lot because it runs so well that it's just boring to talk about. We like to talk about the volatility and the craziness and the spot market, right? Because it's more exciting. And that's where a lot of the problems lie, which is good because that's where the solutions should be focused and in the conversation. But yeah, Ed works in that corner of the market, I think. And you can agree or disagree with me, Ed, that runs very well because it's relationship based. It means that you have a nice niche. You know what your network is, your network optimization, and it becomes a very predictable, stable business.
Yeah, Kevin, I would say it's still trucking. So
it's still you still have fires, right?
But it definitely works better. It definitely works a lot better. I think the only way to have that multi-generational business that lasts for a long time is to think in those terms and build those relationships and move the freight for the same people on the same lanes day after day, so that you can figure out how to control your network and control your costs. And because a point matters a lot in this business, right? So if you can find a way to create a 1% efficiency as a fleet, that could be a lot of money.
Stable lanes, stable, customers, stable lanes, right? That means you don't need a lot of the tech tools that are out there. It also means that should help in the driver turnover, right? The driver turn for fleets that operate like that.
It's got to be lower.
It's got to be considerably lower, right?
It is lower. And then what happens? Then the same driver's pulling the same freight day after day, and that means service levels go up. And now the driver's building a relationship with whoever's on the dock when they're picking up or unloading. It all makes you stickier.
It does, and it's a lot of different areas that make you 1% better, right? And that cumulative growth almost means that you can operate a very profitable business, like that.
Ed, feedback on that. Do you see any technologies coming out that are, common across tech stacks of those smaller or mid-sized fleets that you like to work with that's kind of enabled them to really kind of focus on the service more, right? Enabled them to kind of be a trucking company?
Yeah, I like asking what they're using. Obviously some of the old school TMS systems are still working and helping people, and they'll live and die by them. I don't think they'll even shop. So if they're locked in there, but where I'm seeing a lot of people make moves actually is with their ELDs and their camera systems, and trying to get more efficient with that. And I mean,
lower insurance costs.
Yeah, absolutely. Yeah. And making sure that the driver's comfortable with the tool as well. Does the driver like using it, or are the drivers universally complaining about it? Because driver happiness is important. You know, making sure they're comfortable in the cab.
Yep.
Amen.
It is.
Guys, thank you so much for including me in this. Seth, it was an absolute pleasure.
Yeah, likewise, Ed. Great to meet you. And Kevin and Casey, thanks for having me on. Good to be back.
Good to have you, Seth.
Yes, Seth and I. How many episodes do we do of Great Quarter Guys?
A lot. I didn't know trucking nearly as well as I do now. Those were the good old days for trucking market. I guess I started and there was a freight recession, and then it became the best market of all time. And then, it's just manic. It's
it is
volatility, man. Within 4 or 5 years of my experience, we've had a freight recession, the biggest boom the world's ever seen in trucking and container shipping, and now a 2.5 year depression / severe recession. So
it was the best of times. It was the worst of times.
Yeah, the old Charles Dickens.
Yeah.
Yeah.
Well, thank you guys so much, Ed, Seth. Always a pleasure. And Casey, any parting words?
No, yeah. I mean, thanks for joining us, guys. It's an exciting time to be in the industry, right? We may be in a long played out downturn here, but I don't know. I think we learned a lot in that boom cycle last time around, and maybe we're one step closer to ironing out some of the cyclicality here shortly. So hope these rates keep going up for you boys.
Definitely.
I'd like
All right, guys.
See you guys.
Thank you.
See y'all.